You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. When the financial crisis hit in 2008, Fannie Mae and Freddie Mac went from being private entities to being under conservatorship with the Federal Housing Finance Authority. The implicit government guarantee for the mortgages held by these government-sponsored enterprises, or GSEs, has defined the U.S. housing market ever since, but it's also led to calls for reforms that would decrease the public sector's role in the mortgage market. On today's episode, we talk with Walt Schmidt, Manager of Mortgage Strategies with FHN Financial, about how GSEs fit into the U.S. housing market, the current push for reform, and how the MBS market could respond to any changes. Stay tuned. Coming up soon, our interview with Walt Schmidt, but first, a quick market update. The Fed left rates unchanged this week, as expected. The S&P's 2025 forecast for growth and inflation moved in a slightly stagflationary direction. Although the median 2025 dot still projects 2 rate cuts this year, the central tendency shifted closer to expectations for only 1 rate cut. The key takeaway from the press conference, however, was just how uncertain Fed officials are about the outlook for the economy and rates. Earlier this week, the February retail sales report gave a generally underwhelming update on consumer spending so far this year. After adjusting for inflation and considering downward revisions to January data, spending levels are suggesting a notable slowdown in economic activity during the first quarter. The Atlanta Fed's GDP Now model currently estimates Q1 growth at negative 1.8%, or positive 0.2% unofficially, when adjusting for the unique role that gold plays in some of the statistical accounts. Last week, the February CPI and PPI both rose less than expected, partially allaying inflation fears after red-hot January data showed an abrupt acceleration to start 2025. Because of the methodological differences between the CPI and the Fed's preferred PCE deflator, the Fed policy implications from these reports are expected to be less dovish. Analyst estimates for the February core PCE deflator, when it is released next week, currently center on 0.3%. Also last week, the preliminary University of Michigan survey from March reported steeply deteriorating consumer sentiment and significant spikes in inflation expectations this month. The economy has remained resilient the last few years despite persistent pessimism, so it's unclear whether the uncertainties caused by new federal policies will necessarily change economic behavior. Despite the Fed decision and a few big economic releases over the last few weeks, Treasury yields have stayed within established ranges since late February. 10-year yields are anchored to 4.25%, 2s are centered just under 4%, and Fed funds futures keep signaling expectations for between 2 and 3 rate cuts this year. That's all for the market update this time. Now our interview with Walt Schmidt. Just a heads up that we recorded this interview last week before the FHFA reconfigured the boards of Fannie Mae and Freddie Mac earlier this week. It's not entirely clear how these changes will affect management decisions at either institution, but it's fair to assume the FHFA will now take a more active hand in how the companies are run. All right, on to the interview. Our guest today is Walt Schmidt, Manager of Mortgage Strategies with FHN Financial. Walt, good to have you back on the podcast.
Great to be back, Will. Thanks for having me.
Our topic today is potential reforms to government-sponsored enterprises, GSEs, in the mortgage market. Now, Walt, what exactly is a GSE when we're thinking about the mortgage sector?
So the GSEs, as you rightly said, are known as government-sponsored entities, and the reason they're sponsored, the precursor to them, and specifically we're talking about Fannie Mae and Freddie Mac. Federal Home Loan Bank can also be added to this, but that's not really part of the discussion that we're having right now. So basically Fannie and Freddie. Fannie actually was owned by the government back in the 1930s when it was established, but it was sold off and privatized basically over a period of years in the late 60s and into the 70s. And Freddie Mac was formed around that same time to provide sort of a counterbalance to Fannie. And part of that was during the Vietnam War, and it was done to partially create some more revenue for the federal government, but also just sort of these entities that basically guarantee mortgage-backed securities. And that market also started shortly after that period of time as well.
What is the difference between Fannie Mae and Freddie Mac today? Even if they maybe had different historical origin stories, do they have the same function today?
They have the same function. They're a little bit different in terms of size, first of all. Fannie's assets are just over $4 trillion. Freddie's assets are $4.5 trillion. Freddie's assets are about $1 trillion smaller at just over $3 trillion. And the size of the MBS that they guarantee is also different by about $1 trillion. Fannie's about $1 trillion larger. In terms of residential 1 to 4 family, they both guarantee about $500 billion or half $1 trillion each of multifamily. So Fannie's bigger, Fannie's the older of the two, but functionally they're the same. Their function is to guarantee the payment of principal and interest on MBS securities, mortgage-backed securities. They do that slightly differently, one from the other, but basically it's the same function. They also have different management teams, and so they approach the market in a very similar fashion under the auspices of their regulator, the Federal Housing Finance Authority, but they're not exactly the same one from another. And that sometimes causes some friction in the marketplace, but generally speaking, the market sees them as generally very similar to each other.
And now I noticed that you left out Ginnie Mae. Is that separate from this discussion, or what separates Ginnie Mae from Fannie Mae and Freddie Mac?
So Ginnie Mae is a wholly owned subsidiary of the Treasury Department. So, for example, if an investor invests in a Ginnie Mae security, they get the full faith and credit of the federal government, the full legal faith and credit of the federal government, and therefore it is the same exact credit standard as a U.S. Treasury bond would be. And because of that, from a banking standpoint, there's a zero risk weight for banks to own Ginnie Mae securities, just like Treasuries. For Fannie and Freddie securities, the risk weight is 20%, and that's an acknowledgement of the fact that there is legal support for Fannie and Freddie up to a certain point. That's what happened when they went into conservatorship in 2008. Legally, there's a limit to the amount of support. So again, that's why they're known as government-sponsored entities. They're in this sort of temporary, although the temporary piece has been in place since 2008, so quasi-temporary state of conservatorship under the Treasury Department. And there's a lot of detail behind how that works, and we can go into as much of that as you'd like. But basically, it's sort of the market treats it as not a de jure or a legal backing, but a de facto or an actual sort of practical backing the federal government has for them. And that gets into some tricky legalese at that point, but that's how the market sort of sees them. And so the functional spread that they trade relative to Ginnie has to do more with the prepayment differences among the programs than it does among any kind of perceived credit risk.
And so that de facto guarantee, what I sometimes hear known as the implicit guarantee, that's just because they are perceived to be too big to fail. We'll get into a bit of the history after the financial crisis a bit, but how can this huge market where you have these two institutions with so many assets under management, how can that not be clear? It just feels like if people wanted security, they would need it in writing.
We would love it to be more clear, and we mean market participants would love it to be more clear. But it's a bit of a political issue in terms of the support of the housing market in the U.S. has always been sort of a political issue. How much support should the federal government be giving to the housing market? The GSE system, borrowers in the U.S. kind of think it's of the 30-year fully prepayable fixed-rate mortgage as a birthright. In actuality, that's kind of an anomaly. It really doesn't exist anywhere else in history. It doesn't exist really anywhere else geographically, although it's starting to get some steam elsewhere because of the dominance of the U.S. system. But that system was built and predicated on the GSE system, built and predicated on this sort of at least implicit government backing that guarantees the principal and interest of the MBS. And also back in the day, and again, I'm sort of getting ahead maybe a little of myself a little bit, but a long time ago, Fannie and Freddie had these large retained portfolios that sort of kept mortgage rates and mortgage-backed security spreads in check. And that whole system sort of grew up together. And when the housing crisis hit in 2008, it sort of called into question whether Fannie and Freddie had enough capital. It turned out they did not, at least at the moment in 2008. And so the federal government had to come in and provide actual support. And we've been in this sort of unsteady or uncertain state ever since. And it requires an awful lot of political will for really both parties to come together and come up with an agreement to put them on a more permanent footing. And that just hasn't happened yet since the housing crisis.
So put us back to those few years leading up to the financial crisis. What was the status, legally speaking, or the perception within the market for Fannie and Freddie? And what happened in 2008 and what happened then for the next 17 years?
Before the great financial crisis, they were private entities. I mean, they had common stock that traded, and there was a perception, like you said earlier, that they were too big to fail. Their debt traded at spreads that were tighter than the debt of other financial institutions. And they were considered AAA, even though they technically didn't really have a rating, but the market treated them as such. And then when the financial crisis hit and they went basically negative equity, because a lot of the mortgages that they were guaranteeing through their MBS programs, through their guarantee books, had very significant defaults. And so that ate through their capital. And so between 2008 and about 2012 or so, Fannie and Freddie collectively took down about $200 billion worth of support from the federal government. And so that was part of the rescue plan, if you will, to put them into conservatorship. And they set up what's called the Preferred Stock Purchase Agreement, which basically gave the federal government 79.9% ownership stake. The reason they did that is because if it went to 80, then it technically would be on the federal government's balance sheet. So if you did 79.9, you didn't have to put it on the balance sheet technically. So that's what they did, and like I said, for those few years, collectively, they used about almost $200 billion worth of support, and there's still approximately $200 billion left of support that's available to them in the future, and that's why the market still considers them to sort of be, have this implicit guarantee. There's explicit support that's still there. And then there's still the thought that they're too big to fail, even if they were to eat through that.
I can see how this is a situation ripe for reform because if we go back to the financial crisis, the average American taxpayer does not like the idea of too big to fail. But of course, just as you said, there is this cultural affinity for home ownership baked into the American psyche. And so for a while, that really supported some home ownership, at least in name, but it also shifts the credit risk of mortgages to the American taxpayer. I've got to understand, and so this system is quite unusual, not only historically but also globally. Is it fair to say that the 30-year fixed rate mortgage would not exist in the private market without these GSEs?
I think that's fair to say, and like I said, it's an anomaly, and it kind of grew out of the GSE system. Ginnie Mae actually issued the first mortgage-backed security, but Fannie guaranteed, the early versions of the 30-year mortgage to the borrower. But like I said, Ginnie Mae actually issued the first security in the late 70s and early 80s. And so that market started to develop around that time. And so it really wouldn't exist. The 30-year fully prepayable fixed rate mortgage really wouldn't exist without the GSE system and the way it's developed over the years. And some commentators have sort of argued that that creates too much inherent leverage, because somebody has to own that duration risk and what we call convexity risk, the fact that the bond can be either very long or very short, or the underlying mortgage can be very long or very short. So then the resulting security is the same. And so if the GSEs don't have the large retained portfolios, there needs to be some entity that does that. Well, the Fed did that. Not only did the federal government provide support to Fannie and Freddie in 2008 under conservatorship and the PSPAs, but the Fed bought north of almost $2 trillion worth of the MBS. And then over time, through the pandemic and everything else, they bought a lot more. And so there's been a lot of support both from the central bank and from the federal government for this duration risk, both on the credit side, the guarantee function that the GSEs perform. The federal government had to help with that. And then on the duration and convexity side of things, the Fed, the central bank, had to help with that. Not only is it sort of an anomaly, but it's kind of shown, or we've sort of had circumstances over the last 2 decades where that system maybe, wasn't as robust as they thought it might be when it was developed.
Now, fast forward to today, March 2025, reform seems to be back in the conversation again. Have we seen any explicit proposals to analyze, or is it really all high level for now? So my sense is that ever since 2008, there's been chatter about reforms, but it's never really come to fruition. So are we still at that stage now, or do we have some sort of plan that we can analyze and go through?
Well, there are plans that have been written out. In fact, President Trump's previous head of the FHFA, Mark Calabria, was someone that was pushing very hard for GSE reform during the first Trump administration, and he drew up very specific plans for exiting conservatorship that were predicated on the GSEs building capital. And so there are plans out there. How likely this is under a second Trump administration, the current head of the FHFA, Bill Pulte, there's not a lot known about his positions on certain things. He is an affordable housing advocate. His grandfather started Pulte Homes, and he's been a philanthropist through most of his career. Like I said, an affordable housing advocate. So that, to me, doesn't seem to be the same type of personality that would push very hard for GSE reform like Dr. Calabria was. So that's the first point. The second point's a more practical point, which is these PSPAs have basically grown in value for the U.S. taxpayer. So if they were to release Fannie and Freddie to the private market, there would have to be some kind of agreement with the Treasury Department to release more than $200 billion worth of value that is accrued under these PSPAs. And so, again, that's where the political will comes in, because then the potential headlines would be, well, the taxpayers, just lost $200 billion. Whether that would be true or not depends on how one looks at it, but that could be a headline. And so that would make it very politically difficult for them to then, sort of get past that point and build enough capital to actually be released into the marketplace and then function the way they currently do.
Is the idea behind the capital buildup that we would need to get Fannie and Freddie to a point of investors really feeling confident in their solvency as we transition out of conservatorship to fully privatized entities?
Yes, and then in addition to that, and this next point I'm going to make is very, very important, most market participants that we talk to, both in industry sort of general settings, individual client meetings and things like that, there's another aspect to this entire market called the TBA market, the to be announced market, which is a derivative market that sits on top of the mortgage-backed securities market and basically prices all MBS, whether Fannie, Freddie, or Ginnie. And most market participants, from what we can tell, again, based on these discussions, based on research from other firms, based on a lot of discussions individually with clients, is that most market participants, both on the buy side and the sell side of the market, would be okay, I think, with GSE reform as long as there were some kind of eventual backstop for the credit worthiness of the MBS, right? So there's two different issues. One is the current system supports Fannie and Freddie in their entirety, the entire balance sheet, if you will. Whereas GSE reform could take the form of, we're going to privatize potentially Fannie or Freddie, and then also potentially there might be other GSEs in the future. That's another sort of angle to this whole thing. But that the MBS, much like Ginnie Mae, would have an ultimate backstop from the federal government. And that's the position I think most market participants are taking as they have discussions with policymakers.
If there was a backstop from the federal government for these institutions, how does that even translate into leaving conservatorship into privatization? If there's support from the federal government, it sounds like that implicit guarantee is still there.
The guarantee would still be there, but again, the distinction, and this is a little bit of a, one has to think deeply about this. There's a big distinction between supporting the GSEs themselves in their entirety and supporting the MBS holder, the principal and interest of the MBS holder. So one could envision a world where there is a guarantee function that Fannie and Freddie play, or again, maybe in addition to them, other entities as well going forward. But if at the end of the day there is a complete meltdown of the market, much like what we saw in 2008, that it's written into their charters that the federal government would come in with a backstop, and that would be priced into the mortgage. So it would add probably a few basis points to to the mortgage rate, but it would forestall, or it would render very, very unlikely, a massive sort of breakdown of the system. So again, it would be separating the guarantee function away from the balance sheets of Fannie and Freddie and into the actual security itself from the standpoint of the bondholder. Functionally, it might not sound very different, but legally it would be very different.
And so, as you see it, these different reforms, I can see there's a gradient of intensity for kind of how much government involvement is still there. But is it fair to say that the impact on the MBS market is that spreads would widen in any of this? Do you think there could be a smooth transition, or is it just bound to be disruptive?
Any kind of transition like this would be somewhat disruptive, and that's the other point that market participants make to policymakers. You can have a theoretical view that the government should not be as involved in housing as it is. Okay, that's fine to say that, but if you were to completely pull the government out of housing, there would be a massive disruption. I think everyone's in agreement there. Mortgage rates could rise several percentage points, even though credit spreads in general are very tight right now, and the housing market is sort of underbuilt relative to the population in the U.S. Certainly one can envision scenarios where spreads could gap very wide if the government just were to get out of the market entirely. However, if you look historically at Ginnie performance relative to Fannie and Freddie, right now, if you're at a premium dollar price, Ginnies actually trade cheap to Fannie and Freddie, but that's just because of the prepayment differential, right? Ginnies pay a lot faster, so you're writing down that premium faster. But at discount speeds, Ginnies, again, a little bit because of prepays, but then also because of the zero risk weight. But at par and at discount dollar prices, Ginnie prices are a lot higher than Fannie Freddie. So you could actually make the argument that if the transition's done properly, spreads relative to treasuries for all MBS could tighten if it's done properly, if you had an explicit guarantee. That would be threading the needle a little bit, quite frankly, but, one could envision a scenario where that would be the outcome. Maybe not after 1 to 6 months, but over a 2-year horizon after any kind of massive reform. It could be that credit spreads and MBS spreads, are tighter.
In that transition, which I've got to assume has to be gradual for it to be anything close to smooth, if I bought a mortgage-backed security yesterday, pre-reform, it was under a certain set of circumstances. And is it possible that anyone who held these kind of legacy debt securities would be grandfathered in, so that they have those circumstances that hold against future reforms, or is that too complicated to really keep the market intact?
No, I think that's a possibility for all these, and again, one can think of many different outcomes to take different forms. And that's one of the things that's talked about very intentionally by the industry. And when I mean by the industry, I'm talking about the securities industry, I'm talking about housing industries, I'm talking about mortgage banking industry. I mean, a lot of these trade groups are kind of working together, with policymakers on these issues. And that is one of the issues. And one of the proposals is, okay, whatever you do, whatever you policymakers do as a reform, it really, it's a non-starter if we don't at least grandfather the current MBS into some kind of guarantee system. You could even, I guess, potentially bifurcate the market, that legacy has one set of guarantees and future MBS have a different set of guarantees. I think that would be suboptimal because that would create less liquidity for the market. But that's sort of like a starting point is the current MBS, sort of need to have, this grandfathered, sort of state. And by the way, the PSPAs, Fannie and Freddie still legally have access to, like I said, it's about 240 to 250 billion worth of support. So that's still a legal thing that the FHFA come to an agreement with Treasury, and that's part of the agreement. So that would also play into any kind of grandfathering proposal.
The whole too big to fail implicit guarantee, this idea that these GSEs are involved in home ownership in the US, I think ostensibly it is to increase the accessibility of home ownership.
Yep.
And then maybe the downside of that is it inflates the housing market. People who are risky borrowers get into the market, or people buy bigger homes than they otherwise could afford. How would they affect things like affordability or the systemic stability of the housing market? Will we just be shifting risk to the private sector and it'll become a well-behaved market, and then the expense of that is that it's a little bit more difficult to buy a home?
And you've kind of sort of gotten at a little bit what happened before the 2008, sort of crisis, and that is you had a sort of a hyper version of what you just described, in that you had all this push for homeownership and all that, and it got to the point where you had, in hindsight, which were very risky mortgages, where you had sort of interest only, pick a pay, option arms, and different kind of forms of mortgages. A lot of those weren't sponsored by Fannie and Freddie, but they were all part of the ecosystem, and they were private label. And so this whole push that everyone should own a home, or every household should own a home, that kind of was part of what I suppose got us into the housing crisis. So I think there's a middle ground that policymakers, all stripes, are trying to achieve. I mean, one of the things that you hear maybe from the left side of our political spectrum is to rental housing more affordable, and rental housing has gotten a lot more expensive, despite the fact that Fannie and Freddie, like I said before, together are supporting that market to the tune of $1 trillion. So there's a lot of different ways to tackle affordability, but certainly, keeping some of the premises upon which the market was established, like at least 20% down, fully amortizing principal and interest, no more than a 30-year amortization schedule. I mean, anything you do away from that adds leverage to the market, right? So if you have interest only, if you have a 40-year AM schedule, if you have a lot of ARM where you've got an initial rate that can go up later, teaser rate ARMs are no longer considered qualified mortgages, for example. So this idea of qualified mortgage and qualified residential mortgage came out of the reforms after 2008. Those kind of keep the worst of the largesse at bay. And whether one says that just the fact that you have a 30-year fully prepayable fixed rate mortgage, is that too much leverage? It's pretty impossible to get that basic structure out of the market and to be more like Europe that has 10 and 20-year amortization type of products, or fully adjustable rate products. And so I don't think you can ever get that kind of out of the housing market without a complete correction of the housing market. But there are things that you can do to avoid sort of the worst of the worst in terms of having too much leverage in the system.
Now, would any of the reforms that we've talked about, would they be done unilaterally in the executive branch, or do we need bipartisan agreement in the legislative branch? From the process perspective, I think we can all see the bottlenecks in Congress, but things can be done with much less red tape in the executive branch. So where are the reforms going to come from?
The first thing I would say about that, at least with the current administration, both Secretary Bessent and Director Pulte have both said that any kind of reform needs to be done very slowly, very carefully, very judiciously. They didn't use those exact words, but that's basically what they both said during their confirmation hearings. So that was good to hear from a market participant's perspective. There are certain things that can be done, and of course, each administration puts its own sort of emphasis on Fannie and Freddie. The Biden administration kind of did what we consider to be opening the credit box a little bit more, and did more along the lines of maybe affordable housing goals, whereas obviously the Calabria regime, or the first Trump administration with Calabria as the head of the FHFA, wanted to reduce Fannie and Freddie's footprint and then be able to send them off into privatization. A true privatization, the way that we think about it, probably would require Congress. In fact, most likely would, because you'd have to change their charters. You'd have to change Fannie and Freddie's charters in terms of what they're supposed to do, and you certainly would also have to change the PSPA agreement. Now, that's an agreement between Treasury and the FHFA, but I think it would be very difficult for Treasury to unilaterally just say, hey, we're going to change this in a significant way. Different administrations have made little changes to it here and there in terms of building capital and things like that. But to make a wholesale change, to have true reform where you're really going to privatize these entities, I think that would be politically pretty much impossible without some kind of bipartisan and certainly congressional support.
Political impacts aside and legal obstacles aside, if you were in charge, what sorts of reforms would you make?
Well, in terms of improvement, the GSEs themselves have made improvements in terms of how they run, how they sort of, quite frankly, work together. I mean, before 2008, I don't think I'm spilling the beans at all by saying, they didn't really talk to each other too much because they were fierce competitors with each other. And now under conservatorship, they have to talk to each other. They talk to the regulator all the time about different policies. I think the market would like, because we have this thing now called signal security, where that TBA market that I talked about before, that sort of drives the pricing of everything, you can issue both Fannie and Freddie paper into a TBA transaction. Not really issue, but you can do a transaction based on either Fannie or Freddie paper. And so getting them to have very similar policies, if not the exact same policies, that affect prepayments is something that the market really wants to see. And they've done a good job of that, of kind of working together a little bit more. So what's the grand scheme or the grand design? I think the market thinks about things, and again, we're market participants. The market thinks about things in terms of first principles. And the very first principle is don't harm the TBA market. If you harm the TBA market, the liquidity goes away very, very quickly. And to give you a sense of what I mean by that, on any given day, the FINRA data that's available, between 2 and 300 billion with a B worth of TBAs trade hands on a given day, a normal trading day. About 10% of that trades in the spec pool market, so actual CUSIPs trade, about 20 to 30 billion. And then another 10% of that trades in what's the CMO market, the collateralized mortgage obligation market, which is very popular among a lot of investor types. So the TBA market is the 800-pound gorilla that drives everything. And if you lose, whether it's an implicit or explicit guarantee, I think you'll lose the TBA market, and that would be very detrimental for MBS pricing, and that, quite frankly, would be very detrimental for borrowers. So the first principle is you have to preserve the TBA market. The other principles I think that are sort of very important is that you have to maintain the influence of the market. You can't have some government entity sort of dictating what the mortgage rate should be. We already have the Fed that kind of sets the short-term rate. So I think having the market dictate where MBS are and letting the market freely trade the MBS is another sort of founding principle to any kind of GSE reform. And if you're going to do those two things, it's really difficult. And sort of most of my view on the world is we want to have private markets, but to have a truly private market with no government sort of guarantee whatsoever, you can't keep those two principles sort of together, particularly with the TBA market. So there's a lot of other facets to all of that. I think if they are going to be released, I think, having some kind of government backstop, again, for the MBS, not necessarily for Fannie and Freddie. Those are two different things. Mm-hmm. And that might be the structure and the form that reform takes.
Walt Schmidt, thanks for coming on the podcast.
You bet. Thanks, Wilt.
That was Walt Schmidt, Manager of Mortgage Strategies with FHN Financial. A big takeaway I have from that interview is what Walt discusses close to halfway through, about how the transition to policy reform can be just as important as the destination itself. No matter what policymakers decide is the ideal balance between private and public involvement in the housing market, they have to consider the status quo to minimize the disruptions and risks that come from changes in such a huge market. This risk, of course, has helped contribute to the lack of systemic change since 2008, but it also means that any successful reform will have to happen judiciously. The Conference Board's Consumer Confidence Survey will be released next Tuesday and is expected to show the same deteriorating sentiment and rising inflation expectations reported by the University of Michigan survey last week. Surveys have helped reinforce market expectations for a slowing economy, even though the hard economic data have been more ambiguous. Also next week, the core PCE deflator on Friday is expected to have increased 0.3%. Not alarming, but certainly less encouraging than the cooler-than-expected February CPI. Personal spending is expected to increase 0.6%, much stronger than the uninspiring retail sales report released this week that measures almost exclusively goods spending. The following week, the ISMs and ADP will set the market tone in the days leading up to the March jobs report on Friday, April 4th. Job growth and the unemployment rate have held steady the last 9 months, but workforce cuts in the federal government should start showing up more noticeably in the labor market data with this report. The Fed's pre-meeting communications blackout ends today, leaving FOMC participants free to elaborate on their respective outlooks for the economy and monetary policy. A handful of Fed officials are already on the calendar, and more should pop up as time goes on. Chair Powell is scheduled to speak midday on April 4th, hours after the March jobs report is released. Otherwise, investors will continue to watch political headlines for updates on federal spending, tariff policy, and a possible ceasefire for the war in Ukraine. President Trump has reiterated his plans for reciprocal tariffs to kick in starting April 2nd, but trade policy has been consistently unpredictable since his January inauguration. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.